Good morning, ladies and gentlemen of the press. Before I begin my statement, I'd like to express my deepest condolences to the people who lost their lives in our sister island, and want to assure them that our prayers and thoughts are with them, and our party will work with the government in any way if we can solve the hardships and the problems for the people of these islands that were affected. I will now read my statement on the Sandals Withholding Tax issue, and I will take some questions when I'm finished. Dr. Pierre also will take some questions. As a member of the cabinet from 1997 to 2006 and 2011 to 2016, to the best of my knowledge, the facts on the Sandals Withholding Tax issue are as follows. It must be noted that tax disputes are usually handled initially by the Inland Revenue Department. I want to make it clear that there is a difference between corporation tax and withholding tax, and Sandals, like most other hotels, are receiving incentives and do not pay any corporation or income tax. Withholding tax is a tax charge on payments made to non-residents and is paid by the non-resident company, as compared to corporation tax that is paid on profits by the local company. This was not a tax on Sandals, but on the non-resident insurance company to which the payment or allocation was made. The issue of the withholding tax is based on assessments raised by the Inland Revenue based on Section 76, Schedule 3 of the Income Tax Act of St. Lucia. The period in question are for the years 2001 to 2009. Withholding tax is deducted from payments made to non-residents and companies at the rate of 25% and 15% to CARICOM residents and companies. In 2013, Sandals received concessions for 15 years, but not for the withholding taxes for the period 2001 to 2009. In 2014, Mr. Richard Peterkin, acting on behalf of Sandals, objected to the withholding taxes raised by the Inland Revenue for the years 2001 to 2009 and asked Cabinet to approve, but Cabinet did not consider the request. Further concessions were given to Sandals in November 2015, but not for the withholding taxes for 2001 to 2009. It must be noted that this dispute was a factor in the years 2006 to 2011 when the UWP were in government. The last UWP government under Stephenson King could have considered that matter. Sandals did not agree to pay the withholding tax on insurance payments, since they argued that the insurance cost relates to its global policy for all three hotels in St. Lucia. Sandals says its objection is based on professional advice and the OECS Supreme Court ruling. The Inland Revenue Department does not agree with that interpretation of Sandals and insists that the withholding tax is due and should be paid, since premiums due to non-resident companies is subject to withholding tax as per Section 76, Schedule 3, and such tax must be held for the government of St. Lucia. The Inland Revenue argues that the insurance costs are allocated between the companies and are reimbursable expenses. The Inland Revenue maintains that based on the Income Tax Act, where an expense is charged, even if there is no actual payment, withholding tax must be deducted as per Section 76, Schedule 3, Section 1, subparagraph 3 of the Income Tax Act. Relating to the OECS Supreme Court judgment, the case referred to by Sandals is the Bank of Nova Scotia versus the Appeal Commissioners. The Inland Revenue argues that the case is based on an allocation between a head office and a branch. In the case of Sandals, the hotels are separate companies, and the Inland Revenue says that this case does not apply in the Sandals issue. Sandals contends that due to the high value of their hotels, they have to self-insure. However, the income tax speaks to reinsurance only for insurance companies. reinsurance only for insurance companies and not for other businesses. It must be remembered that for the period 2001 to 2009, Sandals continued to enjoy income tax benefits and other incentives. It is clear that the dispute between the Sandals group of companies and the Inland Revenue Department as to whether Sandals is liable to the government of St. Lucia for $24 million. The Cabinet of Ministers, by Cabinet Conclusion 6/4/2017, agreed with Sandals and not the agents, the Inland Revenue Department. The Cabinet of the St. Lucia Labour Party, of which I was a member, chose not to take action of waiving the taxes claimed, but instead chose to allow Sandals to handle the matter with the Inland Revenue Department. The law provides for a way forward in such disputes. Sandals could appeal to the tax department through its tax commissioners, of which Andy George is the chairman, as permitted by law, or Sandals could bring the matter to the High Court or Court of Appeal, or even to the Privy Council. The St. Lucia Labour Party chose not to intervene as to allow for fairness on both sides. The UWP should have followed the previous government and not intervene or interfere in such matters that relate directly to the Inland Revenue Department, especially when the assessment has been raised and the tax charged by the Inland Revenue. If that procedure had been followed, the matter would not have become a political issue, and the suspicion and negative publicity would not have been generated towards Sandals. I thank you.